And then this question, I think, is referring to the long-term hedge that you've put together, but it may be slightly different. So he's asking, are you continuing to buy the deep out-of-the-money puts on the portfolio or anything of that nature the way you've been doing over the past 2 years?
Great question, actually. Great question. I didn't address it in the slides because I thought it might take too long, but we've actually, so the hedge is, so it's part of my mumbling. So the hedge, to bring everyone up to speed, has been put in place. It's a multi-year hedge that we built when volatility was extremely low over the last 3 years. And it actually worked all right, but it was a lot trickier and more work than I expected when it was working. So what did we do? We bought slightly out of the money puts, and then to help pay for those puts, we sold really far out of the money puts. And so we picked up, in fact, you know what? I do have another slide on this one. So I'll share it just to, oops, let me share this. And I'll see if it goes to the right slide this time. Nope. Interesting. You get to see all those appendix slides. So look, here's at the highest level what was happening. So you can see these numbers possibly. It's kind of along the x-axis here. It goes from 180, 190, all the way up to about 280, and that solid green line is the total payout. And this is like 10% of the S&P 500. So if the S&P 500 is at 280, and what is it today? Maybe it's like 3,100 or something. So if it fell below 280, we would start to receive a little bit of benefit from the put that we bought. And as it continues to basically go down, we see that solid green line spike. So what do? I'll just use some numbers. Let's say we bought a put for 20 bucks. Okay, so this protects us. And it lasts about 3 years. And then we would go down to a price of like 220 or so, and we'd sell a put, which maybe take that purple line or that red line going down. We would sell 2 puts, and we might pick up $15 for that. And we paired all that together and made this nice little basket where this combination developed over years and started to look like this big bold line. But the point is that it would cost us $5, and we were buying really, really cheap puts. So when volatility is low, puts are low. Volatility was very low, so we were able to put this on. When the market crashed with the speed that it did, and I wrote about this a lot in the report, so if you ever want to go back and you can just go to that page and look over the years, we always talked about how this is a multi-year strategy. So these contracts expire each December 2020, December 2021, and December 2022. So when the market crashed, I believe it might have gone down to around 2,300 or so. We were in the right place, but we weren't near expiration. So what that means is the volatility of the put that we bought had gone up. So the $20 we bought had turned into, let's say, $80, which is, or $60, let's say. And the puts that we sold and picked up $15 for, those were going against us until expiration. So those also, let's say, rose to $60. So here we're in a situation where the hedge doesn't help us immediately, which we always knew. But then we were in a new situation where there was so much stimulus going on. It was such a different crisis where it was like designed by us. And then we didn't really quite know what was going to happen, but there's so much stimulus happening. And then the Fed started buying bonds. It just looked like it's very possible that things might recover. And so I didn't want to, I'm just sharing this story with you all. We didn't want to totally miss our opportunity. We had all these super valuable puts that we bought that were offset with the puts that we sold. So we actually did some really shrewd transactions during kind of Q2 where we unwound the puts that had gone, basically they net cost us $5 and they turned into maybe 40. So we got like 700% on some of that, but it left us super exposed on the downside. We had a 1 to 2 correlation. So as things fell, we would get paid on this one, we'd be able to buy this one, and then on the third one, we'd have to buy extra. And that would be an extraordinary situation, but it would be us buying at like 210 for the 2,100 for the S&P 500. So we put a bunch of money in the index. Typically, we wouldn't do that, but we'd be happy to do that at that kind of level. Ultimately, we needed to unwind those. So what we did is we took those 10 quarter puts that were now going out until December of 2022. We actually liquidated those as well and transferred them over into a basket of 12 securities that had a much shorter duration. We repurposed that exposure to 12 securities that had a 3-quarter expiration period. And so we're in that right now. And so we made money on the put as it went down. We lost money on those other puts because we unwound it early. Had we not done this, by the way, it would have been a total just net loss. It would have done zero for us. What we did is was some very shrewd maneuvers. We were able to put that downside exposure to about a dozen different companies. They're not necessarily they're great companies, but things that were just going to do just fine and had been sold and we're going to have cash flow. So in the basket, there's things like Disney's in there. And it's a big basket. So Disney's in there and Starbucks is in there. And we just basically sold out of the money puts on some of these things that were really oversold with a 3-month, 3-quarter rather than 10-quarter duration. And as that's all unwinding, we're making a bit of money. I think we probably still have, actually those contracts still have quite a bit to go. Maybe we'll still gain a lot from those contracts over the coming, over the second half. Probably will add some decent high single-digit returns to the portfolio as well.
And then to follow up on your hedge strategy that you were talking about, would you do that hedge strategy again if volatility again starts to go flat the way it was pre-corona?
So I, throughout this entire process, kept a very detailed journal because it was such a, regarding the hedge specifically, because it was such a weird situation to be in. I know we can't time markets. I know people can't time markets very well. And suddenly I was in a situation that I had created where I had to start making market timing choices. And luckily I made the right market timing choices, but I recognized that prior to this, in a very rational mindset, I thought, well, if we go into a crisis, something like 2009 or something like 2000, or most crises, you don't get a snap. This was the fastest snapback in history, right? So you don't get this sort of combined government action from the Treasury, from Congress, from the Fed, just all at once. And so I'm not sure. In fact, in each letter, if anybody knows Ed Thorpe, I've sort of sent out to the world. I'd love to talk to him about this. He would be the expert that would know. He's the professor from MIT who's ran a very successful fund that was based on a lot of these sort of sophisticated trading techniques. He would definitely have an opinion. I'd love to hear his thoughts. The jury's out on that at this point. It had markets gone down and stayed down, it would have been also really valuable. But I did not I started to say in a rational mindset, I thought, well, we could just wait through the end of December. But it became very obvious that we might not be able to hold on to this through the end of December and have it be worth anything. So for that reason alone, it starts to become less effective. I learned a lot through it. I don't want to ramble through this, but I'll probably write something up in the annual report about it. It's a good question, and I'm not sure yet. I do like having a hedge. Sorry, I will make one other point. Part of the reason we were putting that hedge on was also kind of where we were in the business cycle. So volatility was extraordinarily low. It was actually breaking records on the other side, being below 10 for so long. And so we were getting really, really cheap prices. We shouldn't be able to sort of hedge our portfolio 10% out of the money for $5, which is like a very, very low cost. So, so we did take advantage of that. Luckily, we did the timing right. I'm not sure how much of it was luck or skill. I don't know.
That's really thoughtful, and I'll look forward to reading more about that because I think it's an interesting case study.